Imagine a teenage boy in 1858 walking through the snow with nothing but a bundle of cloth on his back. No office, no brand, no capital, just energy, and a belief that if he treated people fairly, life would eventually treat him fairly too. That boy was Chubei Ito, the founder of what we now know as Itochu Corporation, a 160-plus-year journey that ends with Warren Buffett quietly owning almost 10% of the company and treating it like a forever hold. Today, I'm going to tell you the story of how a peddler's culture, a series of brutal recessions, and one extraordinarily consistent CEO created exactly the kind of business Buffett simply doesn't want to sell. Chubei Ito started as an omi merchant going door-to-door selling cloth. From the beginning, he lived by one idea that shaped everything. Sampo Yoshi. Good for the seller, good for the buyer, and good for society. That sounds like a nice slogan, but for him, it was survival. If he cheated a customer, he'd be out of business. If he pushed too hard, he'd lose trust. So he built his tiny business on fair dealing, long-term relationships, and relentless effort. By the time he died, the one-man peddling operation had turned into a nationwide trading network with hundreds of employees. The culture was set. Work harder than everyone else. Focus on trust over quick profit. And always think in decades, not quarters. That culture is the seed that still matters to us as investors today. Now, most companies don't survive one major crisis. Itochu has survived many. After World War I, Japan experienced a brutal post-war recession. Then the Great Kanto earthquake. The early Itochu nearly went under. What did they do? They made a painful decision: shrink. They cut themselves back to their core, cotton, and even spun off part of the business that became Marubeni. Survival first, ego second. In the 1930s Great Depression, they pushed overseas to places like Australia and Southeast Asia, diversifying their markets when Japan was struggling. In the 1950s, after the Korean War boom ended and many trading companies went bankrupt, Itochu didn't hide. They went on offense and acquired weaker competitors. Then came the 1970s oil shocks. Itochu had made a big bet on energy and got burnt. Instead of doubling down, they learned the lesson. Raw commodities are volatile, margins swing, and one bad cycle can wipe out years of work. So they made a strategic pivot downstream, away from being just a middleman in raw materials and towards owning consumer and brand-driven businesses. That pivot is what eventually led them to things like Pepsi, Chanel distribution, and most importantly, FamilyMart. Again and again, the pattern is the same. Boom, overreach, painful recession, shrink to core, reinvent the model closer to the consumer. That ability to adapt without losing the original culture is what makes a 160-year track record possible. The great pivot to everyday life, fast forward to the 1990s and 2000s. Japan's asset bubble bursts, real estate tanks, financial institutions blow up. Itochu once again feels pain, but instead of chasing another macro bet, they lean further into what Chubei's spirit would approve of: daily life. They deepen their involvement in food, retail, and branded consumer products. They invest in IT and digital infrastructure. And most importantly, they double down on FamilyMart, which becomes Japan's second largest convenience store chain, with thousands of outlets across the country. Think about what a convenience store is. It sells daily necessities. It stays open in crises. It can layer financial services and digital payments on top. This is the exact kind of business that survives recessions and quietly compounds in the background. By the 2010s, Itochu has transformed from a commodity-heavy trading house into a consumer and services fortress. That's the company Warren Buffett eventually meets. Enter Masahiro Okafuji, the Promise Keeper. In 2010, a new CEO takes over, Masahiro Okafuji. If Chubei Ito built the culture, Okafuji is the one who turned it into a modern compounding machine. In his early letters to shareholders, he lays out a few clear promises. Itochu will become the #1 non-resource trading company. Not the biggest in coal or oil, but the leader in food, retail, and consumer. Net profit will reach around $300 billion and then keep growing. They will strictly manage return on invested capital, aiming for around 12 to 15%. And they will keep the stock trading at a disciplined valuation, around 1.2–1.4 times book value, while still returning significant cash to shareholders. What matters isn't just that he said these things. What matters is what happened next. Over the next decade and a half, net profit climbs from the low hundreds of billions to roughly the Y800 billion level. Return on capital rises into the low to mid-teens. Operating cash flow approaches Y1 trillion. Dividends and buybacks together add up to around a 9% yield for shareholders. And despite all that success, management keeps the share price in that same modest price-to-book band. The say-do ratio is insanely high. The promises weren't marketing. They were a playbook. How Itochu behaved in COVID. Then comes the real test for any CEO, a crisis he didn't choose. In 2020, COVID hits. A weaker conglomerate might have seen profits collapse. Itochu does the opposite. They report record net profit over Y500 billion in the middle of the pandemic. Why? Because the pivot Okafuji and his predecessors made is finally on full display. FamilyMart stays open. People still buy drinks, snacks, daily goods. Digital payments usage spikes. The business mix is built to survive exactly this kind of shock. Management doesn't cut the dividend. They don't panic. They keep deploying capital, keep buying back shares, and keep emphasizing long-term return on equity. From Buffett's perspective, this is the ultimate stress test. Does the business keep earning good money in a brutal macro environment, or does it fall apart? Itochu passes that test with a record score. So now, put on Buffett's glasses for a moment. You're looking at a company that has a 160-plus-year history of surviving and adapting through wars, oil shocks, bubbles, and pandemics, has shifted its business model away from volatile commodities into recession-resistant consumer and services, anchored by FamilyMart and a web of everyday life businesses, has a CEO whose promises and shareholder letters turned into reality, higher profits, higher returns on capital, disciplined valuation, and generous yet sustainable returns to owners, and trades at a reasonable multiple around 1.2-1.4 times book value, even as earnings and cash flows climb. From Buffett's point of view, that combination is extremely rare. It's not a story stock. It's not a tech rocket that can be regulated away. It's a merchant culture, scaled up, de-risked, and professionally managed, still compounding quietly. That's why Berkshire didn't just buy once. It kept increasing its stake until it owned close to 10% of Itochu. And unlike some other holdings, there's been no sign of major selling. This fits the pattern of his never sell unless something breaks positions. If you believe that, people in Japan and Asia will keep eating, drinking, commuting, and using convenience stores, management will keep allocating capital with the same discipline, and the culture of Sampo Yoshi will keep attracting customers and partners, then Itochu doesn't just look like a trade. It looks like the kind of business you can hold for decades, letting time and management do the heavy lifting. A teenage peddler in the snow, a culture built on fairness and energy, successors who survived each crisis by shrinking, reinventing, and moving closer to the consumer, a CEO who wrote down promises and then actually hit them, and finally, an Omaha investor who looked at this 160-year journey and said, that's worth owning 10% of. If you enjoy deep dives like this, hit like, subscribe, and I'll see you in the next video.